Hey everyone, and welcome back to the channel. Today we're diving into a book that has genuinely changed my perspective on money and investing. The Simple Path to Wealth by J.L. Collins. If you've ever felt overwhelmed by the world of finance or just want a clear, no-nonsense guide to building serious wealth, then you are in the right place. Collins' philosophy is beautifully simple, yet incredibly powerful, and it boils down to a few core principles that we're going to break down today. He strips away all the jargon and complexity that often makes investing seem inaccessible, revealing a straightforward path that anyone can follow. He argues that you don't need to be a Wall Street wizard or spend hours day trading to achieve financial independence. In fact, he suggests that trying to do so is often counterproductive. The real magic, he says, lies in consistency, patience, and understanding a few fundamental truths about money. One of the biggest takeaways from the Simple Path to Wealth is the concept of FU money. It's not about being rich for the sake of being rich. It's about building enough financial security so you have the freedom to make choices that truly align with your values rather than being dictated by a paycheck. This financial independence allows you to walk away from a job you hate, pursue a passion project, or simply have the peace of mind knowing you're prepared for whatever life throws your way. It's about empowerment, and it's a concept that resonates deeply with so many people. Collins really emphasizes the importance of saving, but not just saving aimlessly. He wants you to save with purpose and invest those savings wisely. And when he talks about investing, he's not talking about picking individual stocks or trying to beat the market. Instead, he champions the power of low-cost index funds, specifically total stock market index funds. His reasoning is incredibly compelling. Historically, the stock market, over the long term, always goes up. By investing in a total stock market index fund, you're essentially investing in a tiny piece of every publicly traded company, diversifying your risk immensely. You're not trying to pick winners. You're betting on the entire engine of capitalism, which has a pretty solid track record. This leads us directly to the concept of simplicity. Collins argues that the more complicated you make your investments, the more fees you'll pay, and the more likely you are to make emotional mistakes. A complex portfolio is not a better portfolio. It's usually just a more expensive and anxiety-inducing one. He famously touts the benefits of the Vanguard Total Stock Market Index Fund, or VTSAX, as being all you really need. This single fund gives you exposure to the entire U.S. stock market with incredibly low fees, meaning more of your money stays invested and working for you. And speaking of fees, Collins dedicates significant time to exposing the devastating impact of high fees and actively managed funds. When a fund manager is constantly buying and selling stocks, not only are they generating taxable events, but they're also charging you high fees that slowly but surely erode your returns over decades. Think of it this way. Even a seemingly small 1% difference in fees can cost you hundreds of thousands of dollars over a 30-year investing career due to the magic of compounding. Collins' mantra is to be a low-cost, low-activity investor. Keep it simple, keep it cheap. This simplicity also extends to how you should behave during market downturns, or what Collins calls the crash. He is very clear. Crashes are normal, they are inevitable, and they are not a reason to panic. In fact, they are opportunities. When the market drops, stocks are essentially going on sale. The worst thing you can do is sell your investments because you're scared. By selling, you turn a paper loss into a permanent, real loss. The best thing you can do is continue to invest, buying more shares at lower prices. He stresses that successful investing is far more about temperament than intelligence. It takes courage to look at a plummeting market and keep buying, but those who can ignore the noise and stick to the simple plan are the ones who ultimately win. We also need to talk about the debt killer. Collins is extremely strict on debt, seeing it as the single biggest obstacle on your path to wealth. He says you should view all non-mortgage debt, especially high-interest consumer debt like credit cards, as an emergency that must be eliminated immediately. He's all for paying off that debt before you even start seriously investing. Why? Because the interest rate you pay on your credit card is almost certainly higher than the return you can reasonably expect to get from the stock market. You're guaranteed to save 20% by paying off 20% interest debt. You are not guaranteed to earn 20% in the market. Once you've crushed that high-interest debt, he makes an exception for the mortgage. Collins suggests that whether to pay off your house early or invest that money is a more nuanced personal decision. For some, this psychological piece of being debt-free, even from a mortgage, is worth more than the potential investment returns. But for others, especially those early in their career, he advocates for the power of compounding. This is perhaps the most important concept in the whole book. Compounding is essentially earning returns on your previously earned returns, creating a snowball effect. The key to maximizing compounding is time. The earlier you start investing, the less money you actually have to contribute overall because your money has more time to grow exponentially. Collins uses fantastic real-world examples to show that a 20-something investor contributing less money over a shorter period will often end up with more than a 40-something who contributes more money over a longer period. This powerful concept reinforces the whole strategy. Invest early, invest consistently, and let the market do the heavy lifting over several decades. Don't touch it, don't time it, just feed the compounding engine. Now let's talk about avoiding the noise. The financial media, Collins argues, is not your friend. Their goal is to generate views and sell advertising, and they do this by creating drama, fear, and urgency. They want you to believe that you need their expert analysis to navigate the markets, but this is often just a distraction from the simple truth. He urges readers to ignore the daily market fluctuations, the talking heads on financial news channels, and the endless predictions of crashes or booms. These things are designed to make you act impulsively, which is almost always detrimental to your long-term wealth building. Your best bet is to set it and forget it. Collins also touches on the importance of your 401k and IRAs. He stresses that these tax-advantaged accounts are your best friends for retirement savings. The tax benefits, whether it's tax-deferred growth in a traditional 401k or tax-free withdrawals in retirement from a Roth IRA, are too powerful to ignore. Max them out if you can. He lays out a clear hierarchy of where to put your money. First, pay off high-interest debt. Second, contribute enough to your 401k to get any employer match, that's essentially free money. Third, max out your IRA. Fourth, max out your 401k. And only then, if you still have money, consider a taxable brokerage account. This sequential approach ensures you're making the most of every dollar, leveraging all available tax advantages before moving on to less optimized accounts. It's a blueprint for efficiency and maximizing your returns. Finally, Collins empowers you to understand that you don't need to be an expert. The entire premise of The Simple Path to Wealth is that investing doesn't have to be complicated to be effective. In fact, he argues that the simpler you keep it, the more effective it will likely be.